everybody, and welcome to our macro chart update on Friday the 5th of March. So yesterday we obviously went down a pretty interesting rabbit hole talking about some quite deep concepts around this idea of Fed funding, the Fed balance sheet expansion, the supplementary leverage ratio on banks, Treasury account drawing and various other things. But the point we're really making about this is that the bond market itself, remember that is the thing that drives the dollar itself in terms of the dollar as a funding currency, is really coming under extreme stress. Jerome Powell spoke last night, obviously following what was clearly extraordinary bond volatility running into month end last week, which caused volatility in lots of other things. And notice how poor liquidity was. We saw that in moves in things like the Aussie, which we were pointing out. And this has been one of our core themes, is this idea that volume and liquidity are being confused, and that is simply not the case. Powell didn't say anything yesterday. Powell tried to literally say as little as he possibly could. So there's two things that we kind of take away from that. Is one, he doesn't mind if rates do continue to back up and we continue to get this steeper yield curve. Two, he maybe wants the steeper yield curve. Maybe he wants it to take the steam out of equities, a dangerous game, because he can lose control of both the front end and the back end of the rates market, and that is going to create some serious issues. But of course, what they believe in, these central bankers, of course, is they believe in controlled outcomes. They believe in hubris. Their hubris is so strong that they believe that they're going to be able to manage that. So what we're seeing in waves and waves are these reflation trade games being squeezed. And at the end of the day, that's what they are, they're trades. So the general liquidation is coming through. And if we just come and look at the dashboard, I think it just illustrates this really beautifully. Let's just look on the week. Silver's down 8%. Copper is suddenly rolling. We've been kind of looking at copper for ages, thinking this looks so stretched, but that has obviously started to roll over. But the one I would point out that hasn't rolled over yet is oil. Now, obviously, OPEC yesterday looked like they basically held the supply cuts in terms of Saudi saying it was going to continue with its 1 million barrel per day unilateral cut. But what we're reading is that it looks like there's going to be an oversupply of oil coming into April. And so this final oil rally that we're seeing here now, this blast up towards 65, is starting to look very stretched for us. We've been oil bulls for a long time here at Atlhough, as you know, but it is starting to look really rather stretched. The other thing I want to point out is the strength in the dollar. So again, the dollar index is up about 1% on the week. Okay, that's not that big, but it is higher, which is really interesting. We'll look at it in a second. But what I really want to look is this. Dollar MEX is higher, dollar yen is higher, and dollar Swiss is higher. But suddenly, look, the euro is breaking down. This has been a trade that we've had on the radar screen for God knows how long. It hasn't worked. It's been a complete dog. But it feels like it's trying to break. And we're going to look at it in a second. This 196.60 level is really important. A stronger dollar will tighten financial conditions, will drive equities down, coupled with higher rates, which will make the dollar stronger, and we get this reinforcement cycle starting to build. And of course, the thing that we're really starting to look to now, we've got non-farm payrolls today. If they're very strong, it's going to put yet more pressure on the bond market to sell off and drive the dollar stronger. But additionally, the big thing that we've got coming up are these three massive central bank meetings, ECB next week, next Thursday, then the week after the FOMC and the BOJ on the 19th, FOMC on the 17th. I think they're going to want to try and announce something potentially at that 17th, which is why he's trying to push back. But the bond market could force something, him to act a little sooner. So volatility is not going away. Let's just come and look quickly at the sector dashboard. You know, a sea of red. The only things up is oil and gas and energy. That's because oil is the only commodity that's up. But everything else looks really ugly. Look at this. Semis thumped. Biotech thumped. Gold just can't catch a bid at all. But in the face of all of this, $400 billion have flooded into global equity funds in the last 16 weeks. It's the fastest ever. But when we look at the focused ETFs, such as ARK, we can see that they're seeing significant outflows. And of course, what do? You have to sell the good stuff, the liquid stuff, to pay for the stuff that you can't sell. When we look at what ARK are selling, they're selling things like Taiwan Semiconductor, they're selling Tesla, they're selling these types of big name stocks where there's some liquidity and pushing it to the downside. Quick look at the radar screen. We've taken those gold call spreads off. It just wasn't going to work. In fact, gold looks like it's breaking down through this 1700 level. We're early on this, and in this liquidation story, gold just doesn't feel like the play to be in. But if we come and look at the radar screen, we're having some really great success with some of our trades which we're really pleased about. The EEM puts, the 19th of March 55 puts, obviously they're working really well. XOP has just been such a great trade for such a long period of time, and we just continue to like it, although we are seriously thinking about maybe booking some profit there, just simply because the move that we've seen in oil. Dollar yen, these dollar yen calls, we obviously rolled the strike down to the June 110s. They've obviously doubled with this blast higher in dollar yen and the strength that we're seeing there, which is good. And finally, the Russell trade. Dollar CAD continues to move, and it's kind of it's a really interesting one for us, while we're not seeing the dollar stronger against the Canada when we are seeing it stronger against everything else. But we're just going to continue to hold it because we do think the vol of it, we bought it at 7.1 in vol, it's now at 8.3. We do like the vol element of this trade. So what I'm going to do now is hop quickly out of here and onto some charts, because it's really what I want to focus on today. Let's just look at the Nasdaq. We've been pointing out the Nasdaq again and again and again. Let me just pull up that's what I want, sorry. So classic head and shoulders. There's so many of these markets showing these head and shoulders patterns in the Nasdaq. We've been pointing out. Look how it's traded beautifully technically, broken down. It's now comfortably below the 100-day. This is in full-blown liquidation mode. We have not seen a break of the 100-day moving average since we saw the break back here all the way in February. And we've been pointing this out. We pointed it out earlier in the week. I'm going to point it out again. Just look at the similarity here between this move here to the downside. Down, pause, down. Down, pause, down, and we wonder if this is where we are. So potential chop and churn. We think we're going to go down and test this down to come and test the 200-day moving average down at 116. It's probably a buy down there. Why? Because we still think that Powell will be forced to do something by the equity market, and that will be the thing that really causes him so much pain. Let's come and quickly look at the SPOO. Clear break of this short-term support line. It's down below its 50-day, got the 100-day coming in here down around 36.85. Let's watch that one. The Russell has lagged but suddenly broke down. We think the Russell is very vulnerable, as you know. Continue to look at that one with great interest. Let's have a quick look at copper. Copper has been one of these huge fastest horses for us. This enormous rally in the early part of February looked completely overdone. Just look how the moving averages are starting to turn here. We would like to see this level around 407, 410 hold. We think there's downside resolution here. And the other one, obviously, that we want to point out just on the commodities before we look at FX today is oil. Very simple. New highs in oil, lower highs in the RSI. Classic RSI divergence tells us that the trend is coming to an end here. Watch out on oil. Could be some short-term trades. That's one other reason why we like to hold the dollar Canada upside. And let's quickly have a look at FX. Euro dollar, again, you can sort of argue you might have some sort of a head and shoulders pattern. It's really difficult to see, but I just make it really simple. 119.55 was basically the lows that we've seen for the year. The Nasdaq is negative for the year now. Let's remember that. Always been a big level, as we can see coming in here. I think if this goes, we're going to come down here and test down to this 118 zone, and some definite weakness potentially to see down there. So we like this euro dollar trade, and remember, let's just quickly come and check this chart out. It's an old favorite. Correlation between euro dollar and the S&P 500. Correlation has really worked. We did this slight breakdown here, and that's because euro dollar topped and went down, and equities did their usual of obviously being the last thing to turn. This correlation is picking up. That's stocks down, euro dollar down, stronger dollar. That's kind of where we feel we are at the moment. So we feel like we're really kind of in the middle of the eye of the storm. Non-farm payrolls today. We're coming into 2 huge weeks. We still think the downside resolution is there for risk. We still think the rates market can continue to push to the top side, and that's what we're thinking. So that's it from us for today. Have a great weekend, everybody, and take care.